Today we're going to walk through how financial due diligence can help you as a business buyer. We're going to talk about how it can help you in your decision-making process, how it can help in your negotiations with the seller, and even how it's going to help you when it comes to drafting your legal documents. Before we do that, let's first talk about what does the actual process of financial due diligence look like. First, when does financial due diligence actually kick off? Financial due diligence is generally going to kick off very shortly after you go under LOI on your acquisition. This is because generally the quality of earnings report is the most likely one to kill your deal. So it's a good idea to get that piece done first so that if your deal is going to die, you kill it early before you racked up too much in other fees and haven't spent too much time on the deal. Once you've officially kicked off, the next thing you're going to want to do is gather information from the seller. You're going to ask for a whole bunch of information from them, and something that will really speed up the process is if you can get access directly to their accounting system. If you can't get direct access, you'll have them download a bunch of information for you, and you'll start by reconciling that information to their source documents. So what that looks like, let's say they have a QuickBooks account. You're going to take what's in that QuickBooks file and do a proof of cash to make sure all that information in the QuickBooks file matches to their bank statements. You're also going to want to reconcile to other source documents like their tax return, their sales system to check against invoices, and their payroll system. Once that's completed, you're going to want to take a look at how the seller has calculated EBITDA. The seller has probably included a variety of adjustments, and your financial due diligence provider is going to start stress testing against those adjustments. Do they agree with the methodology they used? Does the seller have enough support to substantiate those adjustments? Is the bank going to accept with the adjustments that have been proposed? Once that's done, your Q of E provider is also going to start look for their own adjustments. Maybe the seller has made accounting errors and adjustments are going to need to be made for those. Or maybe there's been changes in the business or another anomaly that's occurred that the seller didn't catch, and you want to make sure that you're normalizing the financials for those anomalies. Once you've gone through all of this, at that point, as a financial due diligence provider, I'm probably going to have a lot of questions for the seller. So we're going to pull together a list of questions, send it over to them, and request to set up a call. For most deals under $5 million, 1 to 3 conversations with the seller is probably going to be sufficient for that acquisition. On the larger deals that are more complicated, you may need more conversations, but it's going to be very deal dependent. Once those conversations are completed, we're going to be able to finalize all the adjustments that we're making to the seller's books, with our support for those adjustments and explanations. We're also going to have all those reconciliations we discussed earlier tied out, including the proof of cash, the tax return tie out, the payroll tie out, and the sales tie out. Once that's done, we'll also complete our working capital analysis and any adjustments that need to be made there. And finally, every deal, depending on industry, is going to have key metrics that you're going to want to understand to really understand how profit and revenue are driven in the particular company that you're buying. And a good Q of E report is going to help you analyze that. Those are going to be things like concentration risk, margin risk, maybe turnover and churn, and other measures that help you identify the actual quality of the earnings going into the future with you as the new owner. Now that you have your quality of earnings report, let's talk about how you can use it. One of the biggest benefits of a Q of E is that it can help you bridge the information gap between how much the seller knows about the company and what you know about the company. Some of that information that you're going to get is going to assist with your valuation. When you're calculating the purchase price of a business, there are 3 main things that are going to affect it. The first is your enterprise value. Enterprise value is made up of 2 items. It's a multiple of some measure of cash flow, generally EBITDA or SDE. Your quality of earnings report is going to help you calculate what is the actual EBITDA or SDE of the business that you're purchasing. And ultimately, you're going to decide what multiple you put on those earnings, but your Q of E is going to help you determine what kind of risk factors, red flags, and black holes of information exist that would help you determine what multiple you're willing to put on that company. The second component of purchase price is net working capital. And a good Q of E report is going to help you determine what is the normalized level of working capital that should be included in the enterprise value that you've bought. Now, there will be an adjustment to purchase price in most cases to account for what was the normal level of working capital that the seller should be leaving for you, and what is the actual amount that they're leaving as of the time of closing. And there'll be some sort of true-up mechanism that connects the two. The third component of purchase price is, are there any debt-like items that you're purchasing? Debt-like items are items that aren't traditional debt, but they are debt-like. They're usually hidden liabilities that you're now going to be responsible for as the new owner of the business going forward, that you want to make sure that you're being compensated for. The easiest example of this, and one that we see come up very frequently, would be unearned revenue. This is revenue that the seller has collected from customers, but has not provided the product or service yet. And so you, as the new owner of the business, are going to be responsible for providing that item or service. So you want to make sure that you're getting the revenue from the seller associated with the revenue that you're now performing the obligation for. All the components in that purchase price calculation are things that the quality of earnings report and good financial due diligence are going to help you in calculating, so that you know that your valuation is accurate. When you submitted your LOI, you had limited information that you're submitting the LOI on. And then after due diligence, you've now uncovered a lot more information about this business. That might mean that EBITDA that you had found was a lot lower than what you had initially expected. It might mean that there's a lot more risk factors and red flags that you've uncovered that you didn't know about earlier. Or it might mean that the working capital that you and the seller had agreed upon in the LOI is a lot different than the actual working capital requirement that your quality of earnings report has uncovered. These are all really key negotiating points when it comes to buying a small business, and having the support of a detailed analysis from a third party can be really impactful when it comes to negotiating these items with the seller. And you may find yourself in a situation where you have to do what's called retrade the deal, where you had initially agreed to one purchase price, and now you're gonna try and get the seller to agree to a lower purchase price. And again, having that support from a detailed report is gonna help increase the odds of that renegotiation being successful. Another thing that good due diligence is gonna help you with is wording certain items in your purchase agreement. There's certain items from financial due diligence that will be listed directly into your purchase agreement. That's going to be things around like working capital, how it's going to be calculated, and how the true-up mechanism will work, how debt-like items are going to be calculated and what's going to be included, and even potential items around earnouts or forgivable seller notes that connect with how the financials are performing once you own the business. All those are items that your QOV will help inform, and a good QOV provider can work with your attorney that makes sure they're being laid out in a way that benefits you as a buyer. And finally, one more way that good due diligence is going to help you as a buyer, is going to help you make a plan for post-closing. Through the diligence process, you're going to learn a lot about how the seller has managed their finances up to this point. You're going to learn things about the seller's team and how they plug into the process, the quality of that team, and the shortcomings of various processes that they've created. You can then take this information and create a good plan for post-closing on how to enhance these processes or fill gaps in the ones that already exist. So this report isn't just helping you pre-closing, but it's also helping you create that plan for post-closing so you have a roadmap into the future. If you're looking to buy a small business and looking for a good QOV provider, reach out to me. My name is Chris Barrett. I own and operate Midwest CPA. We help you avoid buying the wrong company and then successfully grow the right one.